Long-dated bond yields are back at levels last seen before the global financial crisis, and that is colliding head-on with an AI-driven equity boom. Welcome to vTalkInsight, Equity Pulse Daily for August 19, 2026, where we connect the macro shock in rates, the energy spike, and the latest company signals into one equity market story. Across the globe, long-dated government bond yields have surged to levels not seen in more than a decade, with the U.S. 30-year around 5.3% and similar moves in Germany and Japan. This is not a marginal shift. It marks a repricing of what the risk-free rate means for every long-duration cash flow in the equity market. The drivers are telling. Much of the move reflects higher real rates and a fatter term premium rather than a simple inflation scare. Persistent deficits, record Treasury auctions, and heavy corporate and AI-related issuance are all competing for capital, pushing up required yields and questioning how sustainable current risk-free levels really are. At the same time, the yield curve has been steepening for several sessions, even as front-end yields soften on weaker data and expectations of a near-term Fed pause. Markets are increasingly focused on the Fed's longer-term reaction function, with upcoming minutes and Jackson Hole remarks seen as critical for clarifying how officials intend to bring inflation back to target. There is a split in interpretation. Some argue that with the whole curve migrating toward roughly 5%, much of the revaluation is already behind us and looks more like a normalization after years of ultra-low rates. Others stress that financial conditions remain loose. Stock-bond correlations are at multi-decade highs, and higher real yields may still be doing the Fed's tightening for it, with clear implications for equity valuations. On top of rates, the energy complex has turned into a major swing factor for equities. Escalating hostilities around the Strait of Hormuz and Bab el-Mandeb, tanker attacks, and Iran's refusal to reopen key routes are keeping Brent crude above $90 and U.S. benchmarks in the mid-80s. Refined products look even tighter. Diesel prices have blown out relative to crude. Russia has extended its diesel export ban, and U.S. refinery utilization is running near 95%. That combination translates directly into higher transportation and logistics costs, feeding broader inflation pressures. Several strategists now flag a dramatic and sustained oil spike as the main risk to equity upside, because it would compress record high profit margins and potentially tip growth toward a harder landing. So far, that worst case has not materialized, but the energy channel is clearly where macro, geopolitics, and equity earnings intersect most acutely. Despite this hostile mix of higher yields and pricier energy, headline equity indices have been remarkably resilient. The S&P 500 remains less than 1% from record levels, even as it heads for a third straight down day, and the Nasdaq sees more pronounced weakness. Positioning data point to very bullish sentiment, with cash allocations around 3.5%, one of the lowest readings since 2022. At the same time, stock-bond correlations are unusually high, meaning traditional hedges are not cushioning equity risk, and both bonds and gold have struggled to diversify portfolios recently. Options markets are starting to reflect that tension. There has been a surge in call option activity on the VIX for September, suggesting investors are bracing for a volatility pickup after the summer. Against that, the 12-month outlook for global equities is still described as constructive, supported by robust earnings growth and S&P 500 margins near 17%, but with a clear risk of a 5 to 10% pullback along the way. The rate shock is showing up most visibly in sector leadership. Tech stocks, especially the AI-exposed chip names, are under pressure, with Nvidia, Micron, and Intel all seeing sharp pullbacks as rising Treasury yields bite into high-growth valuations, and European tech names like ASML and B Semiconductor also trading weaker. In contrast, parts of the cyclical complex look more resilient. A global infrastructure build-out is supporting unusually strong earnings in industrials and materials, and energy equities have been one of the few effective diversifiers in multi-asset portfolios during this rates and geopolitical shock. Financials could also benefit in a scenario where higher yields coexist with solid nominal growth. Rate sensitivity is clearest in housing. Existing home sales fell 1.7% in July. Pending sales dropped 2.3% against expectations for no change, and the 30-year mortgage rate holding above 6.7% is biting hard into affordability. Starter home income requirements have nearly doubled since 2019. Inventories remain below pre-pandemic levels, and demand is increasingly shifting toward more affordable Midwest markets. Regional and segment divergences are widening. The Northeast and Midwest face acute shortages, while parts of the South and West show more supply, and in high-end markets such as New York, all-cash buyers account for around 60% of transactions. That reinforces an equity narrative where housing-related names and rate-sensitive consumer cyclicals face a very different backdrop from energy, financials, and select industrials. Beneath the surface of the tech drawdown, the AI capital expenditure cycle remains the dominant structural theme. Hyperscalers have committed roughly $2.4 trillion to AI infrastructure within an estimated $5 trillion broader AI capex wave, and that build-out is being funded partly by record investment-grade bond issuance, including large multi-billion deals from Alphabet. U.S. corporate bond issuance is running about 20 to the mid-30% higher than last year, with 4 straight record months in investment grade and roughly $1.5 trillion of new debt so far this year. Yet spreads in both investment grade and high yield remain stable or tighter, signaling strong demand even as the sheer volume of supply helps push overall yields higher and blurs diversification between credit and equity risk. At the company level, Nvidia sits right at the intersection of this cycle. Its earnings risk is seen as limited by multi-year AI capex commitments from major cloud providers and projects like a planned $5 billion Ohio data center for OpenAI, even if market reaction could be muted given how widely owned and highly valued the stock already is. Anthropic, meanwhile, is reporting an extraordinary 7-fold jump in annualized revenue to roughly $65 to $70 billion and has reached profitability on an EBITDA basis, reinforcing the idea that some parts of the AI ecosystem are already monetizing demand at scale. There are, however, clear tensions. Nvidia's credit default swap spreads have widened relative to peers, reflecting concerns about leverage and the sustainability of AI-driven revenues, especially if parts of the ecosystem are effectively circularly financed. Enterprises are responding by seeking multi-cloud, multi-model flexibility, using tools such as Snowflake's AI model router, while open-source competition pressures pricing and policy debates over AI taxation and potential workforce displacement add longer-term uncertainty. The global infrastructure and energy transition story is also visible in commodities, with BHP emerging as a key bellwether. BHP plans to increase its copper production by about 50% over the next 5 years through organic projects in Chile, Argentina, and Australia, a strategy that is far cheaper per ton than acquiring assets and comes as copper's near-dated LME spreads hit their tightest levels since 2021. Recent results show a near one-third jump in BHP's profits, driven largely by copper strength. That underscores how the global infrastructure build-out, energy security concerns, and the electrification push are supporting industrial metals demand, providing a constructive backdrop for selected mining and materials equities, even as the broader macro picture grows more complicated. Finally, a quick read on the U.S. consumer comes from Home Depot. The company just delivered its strongest comparable sales since 2022, beating expectations as households continue to spend on smaller home maintenance and improvement projects despite high mortgage rates and housing market frictions. Larger renovation projects, however, remain subdued, reflecting the drag from elevated financing costs and weaker housing turnover. That mix of resilient essentials and cautious big-ticket spending fits a broader equity narrative of a slowdown without an outright recession, where consumer-facing names tied to everyday upkeep look firmer than those reliant on major discretionary upgrades. Putting it all together, equities are navigating a difficult trifecta: long-end yields at pre-crisis highs, an energy market dominated by geopolitical risk, and an AI investment boom that is powering profits while crowding credit markets and lifting funding costs. Index levels still look resilient, but leadership is narrowing, housing and rate-sensitive areas are under strain, and tech is now reacting more sharply to every move in treasuries, even as AI-related earnings and capex stay strong. From here, the key signals to watch are whether U.S. 10 and 30-year yields stabilize near current levels, how oil and diesel prices evolve as Middle East tensions play out, and whether credit spreads remain firm in the face of ongoing record issuance and ambitious AI infrastructure plans from names like Nvidia and Anthropic, alongside industrial bellwethers such as BHP. Those dynamics will help determine whether the current phase resolves in a contained pullback within a constructive earnings cycle, or tips into something more disruptive for equity valuations and sector leadership. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.